Chris Hewett is from TRI Consulting. He's with us in the studio to talk hotels. Malcolm is taking the mickey out of me because I erroneously called Chris Tim earlier on when we were off air. Nearly got away with it, nearly dodged that bullet, but of course not. It's out in the open now. Christopher, good morning.
Good morning, Richard.
There we go. I'm well. Listen, you're here because your latest report on the hotel industry is out, your Hot Stats report, and it's pretty gloomy reading, I have to say. Here's one of the headlines. Falling demand in UAE hotels impacts hotel profitability, and so on and so on. We'll drill down into the numbers in a second, but what's the kind of helicopter view?
Well, looking at the hotel market in Dubai and Abu Dhabi during June, it was a lot softer in performance levels than last year, and a lot of that is to do with the onset of Ramadan, which resulted in falling demand, and as a result, lower average room rates that came into the hotels. And with that and lower food and beverage demand because of Ramadan, we saw hotel profitabilities fall dramatically, especially in Abu Dhabi, which had a profit per available room of just over $1, which is very low. So they're just trading above, or they're just achieving a trading profit.
Just before we start getting into sort of more numbers here, I've just about got my head around RevPAR, revenue per available room, and average room rates and the difference between the two. And now you've come up with TRevPAR, total revenue per available room, and GOPAR, gross operating profit per available room. Just explain to me what GOPAR is as opposed to RevPAR.
Well, if you want to go back a step and look at TRevPAR, that's total revenue per available room. So that's the total revenue a hotel will generate from rooms, food and beverage, minor operating departments with the small little sundries, and then rental revenues that might come through shops or whatever they might have in the lobby. So that's looking at the total revenue. The gross operating profit per available room takes in consideration the profit that the hotel will achieve over that period of time per room that is available, so the total room inventory that it has. So it's a very accurate metric for looking at how a hotel is doing when it comes to the profit that they can generate per room they have within the property.
So Abu Dhabi just about breaking even. It's always difficult to compare like for like, isn't it, when you're looking at the comparative stats, June 2015 versus June 2014, because you've got a bit of Ramadan this year, not so much last year. But you're good at cleaning the data and stripping out these seasonal effects. If you discount for the fact that Ramadan moves, what are you seeing? What's the broader trend that you're seeing for, let's take Abu Dhabi hotels first of all?
Well, what we're seeing is comparable demand levels. So we're seeing similar occupancy levels from last year when we strip out the onset of Ramadan. When we look at the average room rates, the room rates are actually up, which is an encouraging sign, because Abu Dhabi has had a real challenge in the last couple of years when it comes to a significant imbalance between supply and demand. There's been a huge increase in the number of rooms that are coming into the market, and the number of visitors coming into the market hasn't balanced that. So as a result, average room rates have dropped in order to try and fill up the hotel rooms. Looking at Dubai, we're seeing, again, comparable levels of occupancy, but room rates are suffering. The room rates have really gone down this year, and over the last 12 months have gone down about 5%. And a lot of that's to do with more regional issues, what's going on in Europe with the falling euro. The Russian demand has dropped off. So hotels and the tourism authorities have had to shift their focus onto other segments or other source markets that haven't been as high spending as what we have seen in the past.
So here in Dubai, depending on who you talk to, either the hotels are really struggling and laying off staff, and these are really dark times for the hoteliers. But I remember just about a month ago we had the GM from the JW Marriott Marquis in the studio, biggest hotel in town, saying, yes, room rates have fallen every month for the past 12 months. I would still rather be a hotelier running at this size of hotel in Dubai than pretty much anywhere on earth. Because if you look at the rankings of Dubai hotel rates versus pretty much anywhere else, it's top 3, top 5, isn't it?
Well, absolutely. If we look at the fundamentals, there's still significant demand in the market. Hotels are achieving occupancies close to 80% market wide, and with a supply of over 600 hotel rooms or hotels in Dubai, that's a significant performance. What we're seeing at the moment is a softening in the average room rates. Some will argue this is long overdue because the average room rates in Dubai are the 4th most expensive in the world. and it's needed to try and maintain the number of visitors that Dubai are trying to attract, looking up to 2020 when they want to have 20 million visitors. Also, what we're seeing is there's an increase in supply coming into the market. You're looking at about 4.5% increase in supply so far this year over last year, and a lot of that is coming in the mid-market segment. So it's bringing down the average because you're seeing a greater dispensary of four-star hotels which are offering these lower rates and making it more affordable for travellers. So in the long term, we see that the room rates, I think, will come down and continue to come down, and that's because we're starting to see that wider supply within the budget and mid-market segment.
How sophisticated is the sort of the metric and the maths behind all the sort of room rate drops? Do they just drop the rates until they see people starting to come back or attracting more people that would have gone to a lower class hotel, or is it more sophisticated than that?
It's a very sophisticated system that revenue managers adopt when it comes to the pricing strategies. I speak to some revenue managers that will look at their rates 4 or 5 times a day to see how are they performing against their market. They look at fluctuations, how is their competitive set performing, what is happening when it comes to the sources of bookings. Are they coming through their own systems? Are they coming through third parties? Have you got big groups that are coming in that might take up large portions of your inventory?
Presumably because you don't want to keep sharing your revenues with third parties.
Absolutely,
sites, yeah.
Especially with the high commissions that you're paying of 20 to 25% per booking to these online booking agencies. So they really are focused on trying to get that demand through their own channels. But coming back to your point, it is a very complicated system. A lot of maths involved, looking at a lot of systems to try and anticipate what is happening with the rates, and it really is responding to the changes in the fundamentals of supply and demand.
Let's look in a bit more detail at this total revenue per available room and the profitability issue. Total revenue per available room takes in food and beverage, traditionally quite a big part of the revenue certainly for Dubai hotels. A number of hoteliers I speak to saying that model is radically changing at the moment. 10 years ago, your Sheratons, your Hiltons, your Marriotts would own and operate the vast majority of their restaurants and coffee shops and bars and what have you. A lot of people say to me that model is changing, and now they are just renting out that space to independent operators who can do a better job. To what extent are we seeing that happening? Is it the beginnings of a trend, or is it gathering momentum?
Oh, it's certainly gathering momentum. This is a trend that's been happening for the last couple of years. If you look at the hotel development of the past, hotels have always had between 5 and 6 restaurants and outlets. And with every new hotel that comes on, you're going to have a greater competition for this food and beverage spend. If you look at hoteliers traditionally of the past in markets of Europe and the likes, there's always been only really 1 or 2 outlets that a hotel will operate. So to have 5 or 6, or even some hotels have upwards of 50 outlets within their property, it is really pushing the levels of expertise that they can have, and the profit margins that you get from food and beverage compared to rooms is significantly lower. Rooms on average would have a profit margin of about 78 to 80%. Food and beverage can have anywhere between 35 and 45%. So the amount of effort and payroll and costs can be quite substantial, and it doesn't necessarily result in the same revenue per square metre that you get for that food and beverage space. So they're leasing it out because they see the greater benefit of, I don't have to worry about the operational costs and hassle. I get a rent for the space, and the third party operator will take that outlet and run with it. 50
food and beverage outlets?
Yeah.
Those big sort of Japanese hotels. I'm surely not here in the UAE.
Medina Jumeirah is close to 50 food and beverage outlets within the complex.
Chris, it's been great talking to you. Thanks for joining us this morning. Chris Hewett of TRI Consulting, always appreciate